This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, we've already been introduced to how we deal with pension contributions made either by indeed individuals, be that a self-employed taxpayer or indeed an employee, and how where if you are an employee and your employer pays into an occupational pension scheme, the way that such a contribution would be dealt with. If you can't remember that, then you need to go back and look at Chapter 2 in relation to how we dealt with personal pension contributions, which was the same as how we dealt with gift aid payments as well. How we would take the net amount actually paid, gross it up at 100/80 for the basic rate of income tax relief given at source, and that gross figure would then, amongst other things, but most importantly, be used to extend both the basic rate band limit and, if necessary, the higher rate band limit as well. And in Chapter 9, we saw, when looking at what were exempt benefits and what were allowable expenses in relation to the determination of our employment income assessment, that any contributions made by an employer into a pension scheme on behalf of an employee would be an allowable deduction for the employer in determining its tax-adjusted trading profit, and how that any such payment made by the employer would represent an exempt benefit so far as the individual employee is concerned. So what we've seen is the very generous tax relief that exists in relation to pension contributions, whether we're dealing with those made by the individual or those made on behalf of the individual by an employer. As we have said, any employer contributions are tax deductible for the employer, usually a company of course there, in the accounting period in which they are paid. So we get tax relief for the business making that contribution, the employer making the contribution. And any such contribution is an exempt benefit so far as the employee is concerned. If an individual is self-employed, then there is no employer. They have to look after themselves. So on that basis, therefore, the only possible scheme that they could enter into would be a personal pension scheme. And how, when we've made our contributions of, to take a less than random number here as an example, of say £8,000, that when grossed at 100/80, giving a gross personal pension contribution of £10,000, would be used principally to extend, as we said, both our basic rate band and higher rate band limits. Another use there, as we'll see in these notes that are about to follow, of that gross personal pension contribution is that if you had to compute, this again is a Chapter 2 issue, if you had to compute adjusted net income, usually for purposes of determining any restriction in the personal allowance, i.e. because adjusted net income exceeded the income limit of £100,000, then away from our net income we would deduct the gross amount of personal pension contributions. So again, if in doubt, do go back and remind yourself of what we've seen there in Chapter 2. Read the personal pension contributions. It's in the same section and it is the same taxation treatment as given to gift aid payments. And then remind yourself at the introduction to Chapter 9 the way that an employer contribution on behalf of an employee into their pension fund, that would be an allowable deduction for the employer, an exempt benefit so far as the individual is concerned. And then how any employee contributions made into an occupational pension scheme would be given tax relief as an allowable expense against the employment income. Now those points are summarised here. So to begin with, most in fact of what you see on this page, not quite all, but most of what you see is to do with what I've just said in relation to the notes we've already seen in Chapter 2 and Chapter 9. But let's just now go through this, if we are indeed now ready to do that. Right. If you're an employee, then you've got two possibilities in relation to your pension savings. If your employer operates an occupational scheme, and not all do, But if they do, you may join the occupational scheme that will have been set up by the employer. Now, if there is not one of those, then you're just like the self-employed, you've got to look after yourself, in which case there is only the personal pension contribution route down which you could go. If there is an occupational scheme, you as an employee may choose not to contribute into that scheme and instead have a personal pension scheme. So if you're an employee, there's the possibility of either or both schemes being paid into either by you or by the employer, both occupational and personal. It was in Chapter 9 that we looked at the occupational pension scheme contributions. It was in Chapter 2 that we dealt with personal pension scheme contributions. So those contributions there are schemes arranged by the individual directly or with a pension provider. Self-employed individuals only have one choice. That's the personal pension scheme. To encourage individuals to join a pension scheme, we think it is a good idea as a government there for individuals to look after themselves in terms of their later lives. The more they look after themselves in terms of a pension, then hopefully the less the government will have to contribute to looking after them in their older years. So generous tax reliefs have been provided. And again, we have seen the basics of these. What this chapter simply adds in are the restrictions, the limitations that are placed upon the contributions made into a scheme and how then they will be dealt with within the taxation system. Occupational schemes, these run by employers. They will always have contributions made into them by employers. It can't be an occupational scheme unless they do. And may also have contributions made by the employee. Again, the employer may say, the employee can add into this as well, or it may be non-contributory, in which case it's just the employer. Certainly any exam question we get is going to be the combination of the two. No limits on the amount of any contribution that may be made by the employer, but we didn't know about this before. But they will count towards the employee's annual allowance and the value of the fund for the lifetime allowance. And we pick this up in the second section of these notes. What we've seen is that any such contributions made by an employee or an individual here into a scheme is going to enjoy some sort of tax relief. Of course, you don't have carte blanche to put in whatever you wish and be guaranteed tax relief on everything. So there is this, again, main thing for you, lifetime allowance is just a general knowledge that you have to have that. There's going to be no detailed questions on it. But the annual allowance is the one that we need to concern ourselves with. That if the amount of contributions made, combination of those made by the employer, those made by the employee, what we may refer to as our total pension input, if they exceed the limitations placed on us by our annual allowance, then that may result in what we call an annual allowance charge, clawing back some of the benefit of the tax relief that we would otherwise have received. But that awaits us later on in this chapter. These contributions will be tax deductible for the employer, attracting tax relief in the accounting period in which they're paid. Again, as we know, in relation to what we've already seen in Chapter 9. Right. Contributions made by the employer, and again, as we've already said and seen in Chapter 9, are exempt benefits for the employee. Though, as we've said, they may contribute towards an annual allowance charge being made then on the employee. But again, that awaits us in a later section. Whatever, though, they won't be subject to any national insurance contribution payments. That again awaits us in our next chapter. What we didn't know. Contributions made each tax year by an individual into a pension scheme that will attract tax relief are limited to the higher of. Now, one of these figures, £3,600 worth of gross contribution. So, irrespective of whether you have any what we call relevant earnings, irrespective of that, everyone has a right to contribute up to a gross figure of £3,600. Now, I say gross there because what we're aware of is that if you make a personal pension contribution, they are said to be made net of basic rate relief at source. So 3,600 times 80% would equal the personal pension contribution payment that the individual could make, which when grossed at 100 over 80 would give you 3,600. Now, usually the amounts that we are talking about are going to be way, way in excess of that, because here it is the higher of your relevant earnings of the taxpayer. Now, relevant earnings, if you're an employee, employment income. If you're self-employed, your trading profits. There's another possibility there of what are relevant earnings, and that's income from furnished holiday lettings. But that's probably not going to be the case in terms of any exam question you see. So what we're talking about, employment income and or trading profits, these are your relevant earnings. Now, we would think, would we not, that those are very much likely to be a darn sight bigger than £3,600. So almost inevitably, it's the relevant earnings figure that we want. This amount will also contribute towards the annual allowance permitted each year. So we're looking at our total pension input, those contributions made by the employer into our pension fund, those contributions made by the employee. That total pension input will then be compared with our relevant annual allowance to see whether or not any annual allowance charge will be made, which will create an additional tax liability in relation to our income tax computation, effectively taking back the benefit of the tax relief we thought we'd had. Now then, with occupational pension schemes, we know what's happening. The employer contribution is tax deductible for the employer, and it is an exempt benefit for the individual. But when an employee makes a contribution into an occupational scheme, how is it that you achieve the tax relief? Well, it too is said to be given at source, but this is very different to what we talk about with personal pension contributions. It's referred to here as the net pay arrangement, and it's a very simple, practical way of ensuring that the PAYE system, the pay-as-you-earn system that you will have read about in Chapter 9, that it deducts the correct amount of taxation for the employee during the tax year. So the employer will deduct the gross contribution from the individual's employment income before computing the tax to be deducted under PAYE. Very simple. If an employee has a gross annual salary of £25,000 and instructs that he wants £1,000 to be deducted out of that salary by the employer and paid over into his occupational pension scheme. The employer over the tax year will pay £1,000 into the pension scheme, so again month by month over the tax year will pay over the amount totaling up to £1,000, and therefore put a salary through PAYE of £24,000. So each month when the salary is paid over and PAYE income tax is deducted at source, it is as if the taxpayer had an annual salary of £24,000, therefore £2,000 per month being paid, rather than an annual salary of £25,000 divided by 12, which of course would be a bigger figure than that. So effectively, the way in which you achieve your tax relief as an employee in relation to the contributions that you make into the employer occupational pension scheme fund of yours is by getting relief at source by never being taxed on that part of your income in the first place. You had a salary of 25, you want £1,000 to go to your pension fund. It is as if, for income tax purposes, you only had a salary of 24. That tax relief, of course, will be fully available as the gross contribution does not exceed £3,600, and of course your gross contribution is of course well less than your relevant earnings of $25,000. You'd only talk about that in a discursive question. What you're more likely to have to do is to show it on an income tax computation. So what do you show? It's even easier. On the income tax computation, what is the salary? £25,000, from which you then deduct in determining the employment income assessment to show on that income tax computation the employee pension contribution of £1,000, meaning you've got £24,000 showing on the income tax comp as the net employment income assessment. Very easy. Gross salary less the employee contribution. If the employer had made a contribution, that would be, well, ignored in terms of the numbers to go to the income tax computation because it is an exempt benefit. You would always state that in your answer. If there are exemptions, then you will always state that something is exempt. Obviously, unless you're just doing a calculation in answering an objective testing question. But doing a written question, you would explain that the employer contribution into that pension scheme for the employee is an exempt benefit for the employee. Okay, so there we go. If you are a member of your employer's occupational pension scheme, it's ever so easy. What the employer puts in, exempt benefit. What you put in is an allowable deduction from your gross salary. How would you have achieved tax relief for that contribution? Through the PAYE system under something called the net pay arrangement, so that only your salary after deduction of that pension contribution would effectively go through the pay-as-you-earn system and be subjected month by month to income tax charges. So what happens when you contribute into a personal pension scheme? Now again, you could be an employee. It is just that your employer doesn't operate an occupational pension scheme. Or if you're self-employed, this is the only way you can look after yourself in terms of a pension. Then, as we saw, again, we've said this many times in Chapter 2, no such deductions are made from income on the computation. Instead, tax relief is given as follows. So when you've got a personal pension contribution, you do not see that deducted from your salary, deducted from your trading income on the income tax computation. No, it does not represent such a deduction. It does not reduce taxable income. Instead, basic rate relief is said to have been given at source. Using the numbers I quoted a moment ago, if the individual taxpayer pays $8,000 into his pension fund, his personal pension scheme, this is deemed to be net of basic rate tax at 20%. The good news, therefore, is that HMRC will then pay the pension provider an amount equivalent to the basic rate tax deduction. If the net amount is $8,000, 20/80ths of that will be the amount of tax to pay. Obviously, 8,000 grossed at 100 over 80 equals a gross £10,000 personal pension contribution. That is the figure that you need to determine. So far as the pension fund is concerned, it has been credited with £8,000 from you and £2,000 from HMRC. So the individual's pension fund, as we've just said, that gets £10,000, and as the gross contribution exceeds $3,600, again we had that note up here of course, the taxpayer must have net relevant earnings for the tax year of at least £10,000 for tax relief to be fully available. And again, we would again anticipate, wouldn't we, that we will have such net relevant earnings. But again, we need to check. Again, pardon me. Right. So you've got your basic rate relief at source. For every £8,000 that you put into your pension fund is being credited with £10,000. You're getting the £2,000 of income tax back effectively that you would have paid on £10,000 of your income. But of course, we're going to be more likely dealing with higher rate, if not an additional rate taxpayer. So these taxpayers achieve higher and additional rate relief by extending the basic rate and, if necessary, the higher rate bands by the gross amount of the personal pension contribution. Remember, R8,000 gross to 10. Be careful of the question, read it carefully. quite often in a question, the examiner gives you the already gross figure. So by saying made personal pension contributions of £10,000 in brackets gross. Now, if they don't say gross next to that payment, then it is the net figure, and you must gross it times 100 over 80. Of course, if they say gross next to it, that is already the gross figure. Don't go and gross it again. Hence, in the example we've just seen, the higher rate and additional rate tax bands will increase by £10,000. We extend the basic rate band. Now, we know that for our 17-18 tax year that the basic rate band limit is £33,500. Therefore, that would now be extended by £10,000. The additional rate band limit, 150. That would be extended by 10,000. So it would mean that of your taxable income, up to 43,500 would be taxed at 20%. From 43,500, then not up to 150 but up to 160 would be taxed at the higher rate of 40% for non-savings income anyway, and only above 160 would you get into the additional rate of 45%. So the higher rate and additional rate tax will only arise above taxable income figures of, again, hopefully it's already been adjusted on the version of this that you are looking at. That would have been last year, so that's an updating error. I apologise for that. That, of course, should be, and hopefully you're already looking at, £43,500, 10,000 above the 33,500 basic rate band limit, and 10,000 above the 150,000, that's £160,000. If you are dealing with a personal pension contribution, then what we focused on back in Chapter 2 to deal with that was also the idea of when you computed your adjusted net income, a necessary calculation if it went above £100,000, because it would create a restriction of your personal allowance, was that the gross amount of personal pension contributions are deducted in deriving the adjusted net income figure, which, as we've just said, is used to determine if there is any reduction in the personal allowance of the taxpayer. Remember, if adjusted net income exceeds 100,000, then for every £2 of additional income above that adjusted net income limit of 100,000, we will reduce the personal allowance by £1. Now, for 17-18, with a personal allowance of £11,500, therefore, by the time adjusted net income gets to 123,000 and above, that would mean that the personal allowance would be withdrawn entirely there. Okay. Now, this annual allowance here, this is the new bit, as it were, that we have not seen before. The annual allowance. This is going to be a limitation placed on the amount of contributions that will effectively achieve tax relief within any tax year. What will happen if we go above the limit placed upon us by the annual allowance, then something called an annual allowance tax charge will be added to our tax liability, effectively taking back the benefit of the tax relief that we would otherwise have received. So how do we work it out? The annual allowance, we'll call that AA from now on, determining the total pension input allowed for tax relief for each tax year. There's our limit, £40,000. That, again, will be given to you in your tax rates and allowances pages on your examination paper. That we're dealing with 17-18, but from the tax year 16-17 onwards, what was a normal annual allowance of £40,000 is actually now suffering a reduction, a tapering, in a similar way to what we just said we would have as a tapering of your personal allowance. Remember there we said if adjusted net income exceeded an income limit of 100,000, then on a 2-for-1 basis, every £2 of income in excess of that income limit, you'd reduce your personal allowance by £1. So what happens here is that now this annual allowance of 40,000 is going to be reduced by, again, £1 for every £2, by which a person's, and here's your problem, it's another term, this one just called adjusted income. Now clearly you're going to have to learn the definition of that adjusted income. But if it exceeds £150,000, then on a £1 for every £2 excess, we're going to reduce down the £40,000 annual allowance limit, but only down to a minimum tapered annual allowance of £10,000. It will never go below £10,000. Everybody is going to have at least £10,000, no matter how high their adjusted income. So just to illustrate, a person with adjusted income of £180,000 will have their AA reduced because, of course, the 180 exceeds the 150 by how much? That's 30,000. Divide by 2 is a £15,000 reduction. Take that away from your annual allowance of 40,000, it'll reduce it down, therefore, to a tapered annual allowance of 25. 40 minus 15 will be £25,000. If our person is fortunate enough as to have £210,000 or more of adjusted income, then don't bother going any further, just the income, the limit there will have been reached, so everyone will be entitled to the annual allowance of £10,000. Again, if it's 210 or more, 210 minus 150 divide by 2 is £10,000, therefore, 210 minus 150 divided by 2 is 30,000. Take it away from 40,000, 40 minus 30, there is your £10,000. So as soon as you see adjusted income of 210 or more, you already know what your annual allowance is. It's the tapered limit of £10,000. Now, to be able to do that, of course, you need to know the figure of adjusted income. It's one of those nasty little learning exercises, which, of course, tax is stuffed full of. Now, at this stage, in terms of your studies, don't sort of trouble yourself of trying to memorise this at this stage. Read through here, understand how it works, but equally understand that closer to exam date, you're going to have to memorise this, you're going to have to learn it. But again, with the best will in the world, given that there is so much to look at here, this very specific calculation of adjusted income, you try and memorise it now, give it a few weeks, with the flood of further studies coming in, you're probably going to forget it. So you simply have to be aware that this will have to be learned before you walk into that examination room. So what is it? Is net income. Now we know what net income is, I hope, off your income tax computation, the figure before the deduction of the personal allowance. So you start with that. And we add to that plus any employee contributions to an occupational pension scheme. Think if there had been employee contributions into an occupational pension scheme, what would we have done with those? Those would have already been deducted in calculating the net income figure. So we're effectively adding back the deduction that we gave on the income tax computation for the employee contributions to an occupational scheme. What we also add to our net income, again another plus here, any employer contributions to either an occupational or indeed a personal pension scheme. If the company doesn't operate their own occupational scheme, or even if they do and the individual has opted out of it, they may then make a reduced contribution into the individual's personal pension scheme to compensate for that. Now, what you've seen there is that the pluses relate to an employee. Employee contributions, employer contributions there. So that is only relevant if you're an employee. So if you're self-employed, you're an unincorporated trader, well, life is a whole lot easier because your adjusted income will simply be net income. Now, in real life, there's actually another limit that applies here, but that's not within the syllabus, so you don't need to know about it. So although in some of the exercises, depending on what numbers they give you, technically it might not be quite the right answer, they probably will limit their numbers to those that would give you the right technical answer, but it doesn't matter. You will be marked according to these rules here, but they're not the full set of rules that apply in practice, but you're not likely to have to deal with this in practice now, are you? So you're learning this for purposes of the exam. Learn it, therefore. Right. If the AA for a year is not fully utilised, we'll not be putting gross contributions of £40,000 necessarily every year into our pension scheme. It'd be nice if we could afford to do that, but it's unlikely. So if the AA for a year is not fully utilised, and for the tax year in question, the taxpayer was a member of a pension scheme in that year, then it's possible to carry forward any unused amount for 3 years. So any unused allowance out of a tax year may be carried forward and used in a future tax year, but it's only carried forward unused amount for 3 years. So pension contributions made in a tax year will firstly use the AA of that tax year, 40,000 or down to a minimum 10,000, depending on whether your adjusted income exceeded 150,000. So we use that first of all. If the amount of contributions made, your total pension input, has exceeded that annual allowance limit for the tax year, we then start to use up the unused AA brought forward from the previous 3 years. So then followed by the unused AA of the previous 3 tax years, and thankfully used on a first in, first out basis. So we'll use up that of 3 years ago, because if we don't use that this year, it will have gone by next year. So very good news that we use on a FIFO rather than a LIFO basis. So if we have made a contribution in excess of this year's annual allowance limit, 40,000 as a maximum, 10,000 as a minimum, then we go back 3 years, use up any unused allowance of 3 years ago, of 2 years ago, finally 1 year ago. If the amount paid is still in excess of all of that, then what that will lead to, that we'll see in the final section of this chapter, is an annual allowance charge. Although tax relief is given on pension contributions up to the level of relevant earnings of the taxpayer for a tax year, if the tax relief contributions exceed the annual allowance, including, as we've just said, any unused allowances brought forward, then there'll be an AA charge chargeable to income tax at the taxpayer's marginal rate. That comes in note 3. Okay, what I'd like you to do is to have a look at this example here. Aston, compute the total pension input allowed for Aston for the 17-18 tax year. Aston has an annual salary of 120. That will be his relevant earnings figure. And he's got the following gross amount of contributions made into his pension scheme in earlier tax years, and we've got to work out what the total pension input that would be allowed without creating an annual allowance charge this year. So we've got gross, made the following gross amount of contributions in his pension scheme in earlier years. We've got to go back over the previous 3 years, 16, 17, 15, 16, 14, 15, and see whether any unused allowance exists in those years by comparing the contributions made, there they are, with the annual allowance limit for each year of 40,000. Quite clearly, where there was 62,000, there would have been, again, no unused allowance. But where it's 30, where it's 25, that would create an unused allowance. We've got to work out those figures, add them to the 40,000 annual salary, add them rather to the annual allowance of this year of £40,000 to work out what the total pension input allowed for this year would be. In relation to the limitation of adjusted income, then we've got no problem here because we've only got an annual salary of 120,000. We can dream, can't we? We've only got an annual salary of 120. We do not exceed the adjusted income limit of 150, so there'll be no restriction in the 40,000 annual allowance for the year. Now, I'd like you to work that through for yourself before next time. Check out with the answer in the back that bit, but that answer also then goes on to suggest, well, what about if we made this contribution? If you have a little read through that, but at the beginning of the next session, I will talk you through that as well, before then moving on to complete this area, this chapter, by looking at, so what does happen when the total pension input for the tax year exceeds that combination of annual allowance limit for the tax year plus the unused allowance brought forward from the previous 3 years. When that happens, how do we get the annual allowance charge? How do we work the tax thereon? Okay, look forward therefore to finishing off this chapter with you in our next session together.